Thank you, Andrew. Good morning, everyone. It's great to be back here in Busan. As Andrew said, my presentation today is entitled Strong and Efficient Fundamentals, a Sustainable Combination. And what I hope to do over the next 20 minutes is just to give you a view of how we see the shipping markets have been developing and how we expect them to evolve over the next couple of years and in some cases over the next decade or so. But what I thought I would do just to get things going, to get everyone in the mood thinking about shipping, is to just look at how the shipping markets have performed over the last 12 months or so. And these two charts just show you how the one-year TC rate and 10-year-old prices have changed from August last year to today. And we can see for all sectors, apart from LNG, we've seen positive movements in both earnings and values. And in some cases, container ships, the offshore market, we've seen very significant positive moves. Earnings have been so positive that for some sectors, they're sort of peaking out at the highest levels that we've seen for the last 10 years. This chart, the blue bars, show you the highest earnings that we've seen over the last decade. The green circles show you where earnings are today in relation to that 10-year high water mark. And we can see for chemical tankers, for ro-ros, for car carriers, offshore, some of the gas sectors, we're seeing earnings at or near historical highs from the last 10 years. So a positive market generally for shipping. So where are we on the earnings cycle? For anyone that's not seen this infographic before, what it's designed to do is just to show where I think each sector is on its respective earnings cycle, and also how we compare and contrast different sectors across shipping. We can see a lot of sectors on the left-hand side of the chart. This is where fundamentals still remain relatively positive, but earnings have come slightly off of where we've seen perhaps over the last 12 to 18 months. We can see LNG is sort of on the right-hand side of that left-hand group of asset types. Here we've seen a weakening in earnings over the course of the last 2 years. Now if we move across to the right-hand side where earnings are improving, we can see offshore. Offshore has been improving over the course of the last 24, 36 months, and we do expect to see another 12 months of improvement in the offshore sector. And perhaps the most interesting sector from my perspective is container ships. If I'd have put this chart up, this infographic up 12 months ago, you would have seen containers on the left-hand side with earnings coming down. Now they're firmly on the up and at a high level in terms of one-year TC rates. And the reason that they've sort of switched from the left to the right, I mean, we have seen strong fundamentals, strong demand in the container ship market, but what we've also seen is a series of events that have helped push the container ship market back up to sort of levels that we haven't seen for the last 24 months. And that got me thinking. We seem to see increasingly more events. More events have happened, I would say, in the last 5 years than they have done over the course of the century. And I wanted to try and put some numbers on this. Given I'm a scientist by background, I like to have numbers. And I thought the best way potentially to do this was to look at Google Trends. Google Trends just tells us how many times a search term has been put into Google. And the search term I chose to enter was Black Swan event. And as you can see from this chart, without sort of any due doubt, the last 5 years we've seen a lot more instances of at least people searching for Black Swan events on Google than we have done in the previous 2 decades. So there are numbers to back up the fact that we are going through an event-driven shipping market over the last 4 or 5 years. And if we try and translate that into shipping, what I would say that events have become thick and fast. This is the BDI, and I've overlain a number of events that have happened over the course of this century. Events are becoming thick and fast. However, shipping has managed to deal with these events very well, I would conclude. What they have typically done is cause uplift to earnings and increased volatility. And you'll see also in this chart in the top left-hand corner of the chart a little table, and that's just a volatility measure. And we can see the volatility over the 2020s has been greater than either the 2 decades that have gone before. So we're in a heightened volatility market and potentially more events on the way. So what I want to do now is drill down a little bit more detail on the demand side of the industry. And what I thought I'd do is just start off again just by doing a general overview. Here we have cargo growth for a range of shipping sectors. I've detailed 2023, so last year, our view of 2024, and our forecast for next year. And if we focus in on 2024, the yellow bars, we can see that across the board, demand has been robust. We've got no negative cargo growth rates. Last year, we saw negative cargo growth rates in the container sector. We're not seeing that this year. And if we compare 2024 to the average of the last 10 years, yeah, in some instances it's below, but in many instances it's level or above the historical average. So demand isn't looking too bad. If we look at some of the individual sectors and see how some of those events have helped drive those demand numbers, that's what I'm going to plan to do over the next sort of 3 slides. This one I'm starting off on dry bulk. The top left-hand chart on this slide shows you Chinese coal stockpiles. Dry bulk continues to be very much driven by the Chinese economy and what's going on in China. Last year, and part of this year actually, we've seen reduced rainfall in China and a reduction in hydroelectric production of energy within China. And to compensate this, China has imported more coal to enable energy production to remain at a stable base. They've imported more coal to utilise in power plants, but they've also stockpiled a lot of coal, as we can see in this chart. Now that, of course, has been good for shipping over the last 18 months. However, if we look forward, those stockpiles will have to be used. So it's a positive up till now, but it could prove to be a negative in the short to medium term. We've just heard from Dr. Park about the softening in the Chinese economy, and the chart on the bottom left there sort of helps sort of round out a little bit more from what we're seeing from a shipping perspective. We can see that Chinese cement imports have actually been very low. The stimulus that has gone into China so far hasn't been able to generate interest in that real estate sector and the construction industry. Having said all of that, the chart on the right, which is our aggregated view across commodities and dry bulk, we can see that incremental seaborne trade in 2023 was very strong at 160 million tonnes. This year it's more like 70 million tonnes, but we can see for the next couple of years we do expect to see dry bulk incremental trade at around 100 million tonnes. The interesting point I would say here is, as we look into the second half of this decade, the growth is going to come more from minor bulks and from grains rather than coal and iron ore. And we'll come back to that theme a little bit later in the presentation. On the oil tanker side, the chart on the top left shows oil demand growth, and we can see the impact of a policy change in China, stopping the zero COVID policy did to oil consumption within China. We can see the light blue bar, 12% oil consumption growth in China last year. That has naturally dropped down this year, and we're seeing more like 4% this year, and it will continue to sort of fall, but be positive over the next few years. Another policy change on the bottom left, which is sort of another event-driven incident, has been OPEC cuts. So we've seen OPEC cuts over the course of last year. They continue to cut production, but at the same time, the Americas, both North America and Latin America, have increased output. So that, again, has changed the view on shipping and can change the trade dynamics of the oil tanker sector. But on the right, we can see our view of incremental seaborne trade, which does remain positive. As we move into the second half of this decade, it will be more the products that will drive trade growth rather than crude. From a containers perspective, the top left-hand chart just shows our view on mainland quarterly head haul volumes. And we can see that in Q2 2024, total volume sort of reached those sort of COVID levels. So we've sort of climbed back from that negative growth that I mentioned in one of the earlier slides in containers to positive growth. Not so much on the Trans-Pacific, though we've seen some strong Trans-Pacific numbers quite recently, but certainly in Asia, Europe and Transatlantic have helped push that aggregated main lane trade numbers higher than we've seen historically. Where we've seen the real growth, however, have been on some of the non-main lane trades. The bottom left-hand chart, the Far East non-main lane trades, we can see that that has been growing over the course of the last 18 months, and we expect that to continue to grow and be a good fuel for growth as we move through over the next couple of years, as we can see on the chart on the right. So the chart on the right certainly shows that intra-regional and those non-main lane trades are going to be the sources of growth rather than traditional big main lane trades. So demand has told us something about what's been going on in the market. As we've seen, demand has been relatively strong. I wouldn't say it's been stellar. Where the sort of the froth, the top of the market has come from is from some of the inefficiencies that we've seen within the markets. Now, since COVID, I would say there's been two very large inefficiencies or market-driven events that have led to shipping inefficiencies. The first has been the Russian invasion of Ukraine. That has altered energy trade flows, and we don't expect to see any changes anytime soon. And when I say it's altered energy trade flows, we can simply see here on the chart on the left, which shows Russian oil export flows to Asia, how it was next to nothing before the invasion, and since then it has elevated to high levels. This has been fantastic for the tanker markets. We're now seeing oil which was shipped short sea or piped into Europe going from Russia to Asia to the Middle East. That crude is then being shipped back to Europe. So we've gone from a situation where we didn't need hardly any ships to needing lots of ships. LNG has also been influenced by what has happened in Ukraine. Initially, it was Europe importing a lot of LNG, as we can see by the yellow bars on the chart on the right. More recently, we've established some normals in terms of levels. Europe isn't importing and sort of stocking up as it needed to do in 2022. But what we have seen on LNG is a change in the trade routes. Historically, we saw a lot of US LNG being transported to Asia for consumption. The majority of that US LNG is now going to Europe, and it's the Middle East that is picking up the slack and transporting or exporting LNG to Asia. So we've seen a development which we think will stick now in terms of LNG flows. But of course, the big events over the course of the last 12 to 18 months has been in and related around the canals. Initially, the Panama Canal. A lot of the disruptions there have now been alleviated, and we're seeing return to normal at Panama, but we're not seeing that on the Red Sea and the Suez Canal. And this is just a heat map from our AIS analysis for two sectors of the tanker markets, sort of pre and post troubles on the Red Sea. You can certainly see differences in the trade routes, with a lot more vessels having to travel around the Cape of Good Hope. Not all vessels are travelling around the Cape of Good Hope. For tankers and bulkers, it's around 60% of the fleet that would have gone through is now going around the Cape of Good Hope. For liner industry, for containers and for car carriers, it's pretty much everything is going around the Cape of Good Hope. And that is producing a lot of inefficiencies and is extending the ton-mile impact. These charts here just show you the year-on-year changes in tonnes, so cargo on the water, versus ton-miles, so the cargo on the water and the distance it has to go. If we just look at one chart, just the top left, the crude oil for 2024, we can see that our tonne year-on-year growth is around 1.5%, whereas the ton-mile, both factoring in the distances from those Russian barrels, but also the deviations around the Cape of Good Hope, we go from 1.5% up to more like 5% year-on-year growth. So a huge inefficiency that's been brought in to the system. Where we've perhaps seen most inefficiency or most rerouting, as I say, is the container industry. And that has been something of a godsend to the container industry, given the volumes of containers that are coming out of many of the Korean shipyards and also the Chinese. And if you actually marry up, which we've tried to do on the chart on the left, how much new tonnage has been released in the market and how much tonnage we've needed to meet incremental demand, but also that rerouting, we can see that actually those two numbers are very well balanced by the blue and the yellow bars. And why are charter rates so high at the minute on the container side? Well, if we look at the chart on the right, we can see there's pretty much no idle tonnage in the container ship market. So if you want a container ship to run into the Mediterranean, because a lot of the liners are having to run smaller ships into the Med, the East Mediterranean ports, whereas before they would call as they went through the Suez, you're going to struggle to get a vessel and you're going to have to pay some high prices. So just a few slides on some more structural demands, which I thought would be interesting as we sort of look beyond the next 2 to 3 years. One is China. China has been the growth of trade for shipping for over 20 years now. It is slowing. I guess this is natural as the economy develops, as the economy matures, as we see more of China sort of reach their urbanization rates. As we can see from the charts on the screen, residential property sales, Chinese steel output, oil refinery capacity. It's not like this has happened overnight. This has been slowing for some time. And I guess the concern perhaps is with the economy more generally is the age profile, the demographics of the population in China. If we look at the chart on the bottom right, we can see that China's population is now becoming quite old and can't necessarily contribute to the economy like it could do 20 years ago. I've put a comparison there of India and Nigeria, and you can just see how young those populations are and where growth is going to come from these populations. It isn't all doom and gloom. China will continue to grow, but at a slower rate. Other countries will come in and help supplement that incremental demand. South Asia, specifically India, is certainly one. We can see our longer-term forecast for coal and crude inputs for both China and India on the top charts. And we will start seeing new cargoes. Green steel requirement for HBI and DRI. We can see that we're going from basically nothing to over 100 million tonnes of HBI and DRI that will need to be shipped over the next couple of decades. And of course, clean methanol and clean ammonia. Two cargoes which shipping will both consume as a fuel, but also have to carry. We will need in excess of 250 million tonnes of those products being shipped, which will lead to around 400 VLACs, around 250 methanol carriers by 2050. That leads me on just to mention briefly the energy transition. These are our views from our energy model on how the energy transition will unfold as we move out to 2050. That will impact shipping. We won't need as many vessels carrying coal as we move out. 2050, of course, is a long way in the future. The thing I would say is if we look at 2025 on these charts, we are sort of in the transition zone. We're about to see a change within the industry, and we will start seeing a reduction in things like coal and oil growth. So I've done this, the demand, the inefficiencies, and the longer-term views. Just moving on onto the supply side, contracting this year has been very strong. It sort of tailed off a little bit, as we can see on the chart on the left, at the back end of last year. But certainly, as we've worked our way through the year, contracting levels have rocketed up. We can see, again, containers and gas carriers and tankers. We're starting to see more tankers being ordered. Where these orders are being placed, in some senses, they're required in terms of replacement demand. We also think that we still need to see some orders for some other sectors. The chart on the right just shows you the old fleet and the order book. So it's the order book as a percentage of the 15-year-old fleets by vessel type, by vessel size. The red bar is where we would say we've perhaps seen over-ordering. The yellow bars, perhaps some concerns. The blue bars is where we probably need new ships being ordered at some time soon to replace an aging fleet. The fleet is starting to move to dual-fuel technologies, certainly for the container and car carrier sectors. It's perhaps natural that those are the sectors that are coming first, given their proximity to the end consumers, given that they operate on liner routes whereby you can help secure fuel supplies at either end of those liner routes, and also that they're sectors that have done very well recently in terms of cash in their pocket. They can afford to spend a little bit more on the additional capex involved in dual fuel. We've not seen so many dual fuel on tankers or dry bulk. We do think that they will come, but potentially within the next 3 to 4 years. What we also think we'll see a lot more of is engine retrofits and retrofits of energy-saving technologies. As I mentioned, the fleet is getting older. A lot of those vessels will have to do something to keep them in line with regulations as they come round the corner. But China this year has been dominating deliveries, as we can see on the chart on the left. Over 50% of all output this year in GT has come from the Chinese yards. They have managed to do this in 2 ways. One, they've increased productivity. They've recruited workforce that was operating in the construction industry and have placed them into the shipbuilding industry. And 2, they've been able to increase shipyard capacity. As we can see from our chart on the right, this is our view of shipyard capacity, and we can see that green element of the chart has grown over the course of the last few years. This elasticity in shipyard capacity is something that MSI has been talking about for some time, and just to prove that, this is a slide that I put up in 2017 at a Marine Money conference, whereby I said that STX Dalian, although it had been mothballed at that time for 2 years, would come back in the future once the shipbuilding markets had improved. And as we all know, STX Dalian is now Hengli Heavy Industries and is producing a lot of vessels that will come out of the yard over the next few years. So finally, earnings and values. New building prices for ships we do think will come down in the second half of last year. The reason I say that is, one, we're not necessarily seeing the same cost inflationary pressure that we've seen at the yards. As we can see on the chart on the left, they've come off over the course of the last 18 months. And secondly, we do believe that next year we will see more vessels delivered than we will see being contracted. And as we can see on the chart on the right, when we look at this net position of the order book, whether it goes up or goes down is very well correlated with new building prices. So we do think there'll be a softening. It won't be a collapse. It will just be single-digit softening of the new build price that will start in the second half of next year and lead into the following year before we see an uptick in new building prices. Earnings will remain robust, very much dictated to, of course, by what goes on in the Red Sea. The chart on the left-hand side for tankers and bulkers shows if we stripped out the diversions around the Cape of Good Hope, how much lower would one-year TC rates be for oil tankers and bulkers? And we can see between 10 and 15% of current earnings is being dictated to by those diversions. But as we can see from the chart on the right, which has our forecast for one-year TC rates, they do remain quite strong. They do remain at or above levels that we've seen since 2010. Asset values will soften as we move out into the second half of the decade. This is just a distribution of asset values across a range of sectors of shipping. The yellow bar is where asset values are today. The red bar is where we see them at the end of 2028. You can see that the red bar is always to the left of the right bar of the yellow bar. What that means is that we will see a softening in asset values, but do take note of where the mean and the medians are on these distributions. The red bar is always at or above the historical median or asset values apart from the container ship market. And finally, I always like to end a Marine Money presentation by trying to put everything through our systems at MSI and look at where the best investment opportunities lie in shipping. And in this instance, this exercise, what I decided to do was say that I went out with a big pile of money in my pocket, and I went out and bought some ships, some 5-year-old ships. I fixed them for 3 years, and then I sold them in 3 years' time. Where would I get the best returns? And as we could see currently from the MSI models, we think that the best returns, the double-digit returns, can be expected in the offshore sector, the car carrier market, and the container ship sector. So thank you very much for listening, and I hope you enjoy the rest of the conference.